Hello, my dear students. A very warm welcome to all of you in Shri Jayendra Rank Zone. I am your friend and mentor for this subject, Principles and Practices of Accounting. In this lecture, we'll continue with Accounting Chapter 5, that is Concept and Accounting of Depreciation. All the concepts will be covered in the coming series of lectures. So let us begin. This is lecture number 15. Okay, so let us continue today from this topic, that is a revision of estimated useful life of PPE, property, plant and equipment, as per AS 10. The residual value and the useful life of an asset should be reviewed at least each financial year end, and if expectations differ from previous estimates, the changes should be accounted for as a change in accounting estimate in accordance with the accounting standard. Whenever there is a revision in the estimated useful life of the asset, the unamortized depreciable amount should be charged over the revised remaining estimated useful life of the asset. Let us see an illustration in relation to this. Let us do one illustration in relation to this. Illustration 12. Illustration 12. A machine costing rupees 6 lakh is depreciated on straight line basis, assuming the useful life is 10 years. So 10-year working life and nil residual value for 3 years. The estimate of remaining useful life after 3 years will be reassessed at 5 years. Reassessed at 5 years. Required. Calculate depreciation for the 4th year. What is required in this question is calculate depreciation for the 4th year. Okay. Solution. Solution. Depreciation per year. Depreciation per year equals cost is 6 lakh. Scrap value is nil divided by estimated life, which is 10 years. So depreciation per year is 60,000. Depreciation per year is 60,000. Next is depreciation on straight line method charged for 3 years. Depreciation on straight line method charged for 3 years. So it is 60,000 for 1 year multiplied by 3 years equals rupee 1 lakh 80,000 equals rupee 1 lakh 80,000. I believe it is clear. Let us continue. Book value of the computer. Book value of the computer at the end of third year at the end of third year. So cost was 6 lakh, depreciation till date is 1 lakh 80,000. So book value is 4 lakh 20,000. I believe it is absolutely clear. Let us move ahead. Book value is 4 lakh 20,000. After 3 years, the remaining useful life is 7 years. Remaining useful life as per the previous estimate equals 7 years. Remaining useful life as per new revised estimate equals 5 years. Equals 5 years. Depreciation from the fourth year onwards equals cost is 4 lakh 20,000 and the life is 5 year and scrap value is nil. Solve it. 4 lakh 20,000 divided by 5. 4 lakh 20,000 divided by 5. 84,000 per annum. 84,000 per annum. Let us continue. Let us continue. Write an illustration. Write an illustration. 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 A company a company whose accounting year a company whose accounting year is the calendar year purchased purchased machineries on 1st of April 2018 costing rupee 30,000. It further it further purchased a machine it further purchased a machine costing rupee 20,000 on 1/10/2018 1/10/2018 and another machine costing rupee 10,000 on 1/7/2019, on 1/1/2020, on 1/1/2020, on 1/1/2020 of the machineries of the machineries which were purchased on 1st of April 2018, one machine one machine costing rupee 10,000 one machine costing rupee 10,000 became obsolete became obsolete and was sold for rupee 3,000 and was sold for rupee 3,000. Show show how the how the machinery account would appear how the machinery account would appear for all the 3 years for all the 3 years in the books of the company in the books of the company after charging after charging after charging depreciation after charging depreciation after charging depreciation at 10% per annum at 10% per annum on written down value method on written down value method on written down value method. Kindly refer the question once again. Kindly refer the question once again. A company whose accounting year is the calendar year purchased machineries on 1st of April 2018 costing 30,000. It further purchased a machine costing rupee 20,000 on 1st of October 2018 and the another machine costing 10,000 on 1/7/2019. On 1st of January 2020 of the machineries which were purchased on 1st of April 2018, one machine costing 10,000 became obsolete and was sold for 3,000. Show the machinery account how it would appear for all the 3 years in the books of the company after charging depreciation at the rate 10% per annum on written down value method on written down value method. I believe you understood the question. Let us try to do the solution. Let us try to do the solution. 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 First of all, we need to compute depreciation for all the machineries. So, working note number one, working note, working note, working note one. Computation of depreciation, computation of depreciation. Machines purchased, machine purchased on, machine purchased on. Write the date over here. So 1st of April 2018 there is a machine purchase. Now 1st 10 2018 another machine was purchased. 1 7 2019 machine 1 purchased, and over here total in the last column. Let us see the cost. Cost is 30,000. 1st April 2018 the cost is 30,000. The cost is 20,000. For 1st October 2018 the cost is 20,000, and 1 7 2019 the cost is 10,000. The cost is 10,000. Over here the cost is 20,000. Over here the cost is 10,000. Less depreciation, less depreciation, depreciation at the rate 10%, at the rate 10% per annum, at the rate 10% for 12 months, that is per annum. Over here, the depreciation is charged for only 9 months. So 30,000 multiplied by 10 by 100, 10% multiplied by 9 by 12. Do it on your calculators. It is 2250. 2250. Over here, depreciation is calculated for only 3 months. 10, 11, 12. 3 months, 10, 11, 12. So it is 500. It is 500. Over here 9 months, over here 3 months. This is nil. Total depreciation 2750. Total depreciation 2750. Stretch these lines. Stretch these lines. After deducting it, written down value, calculate written down value. First write the calculation over here. First of all, 30,000 multiplied by 10% multiplied by 9 by 12. This is 20,000 multiplied by 10% multiplied by 3 by 12. I believe it is clear. I believe it is clear. Write written down value. Write written down value. WDV written down value. 30,000 minus 2250, 27,750. 20,000 minus 500, 19,500, and 10,000 nothing. So written down value is 10,000 over here. I believe it is clear. Less, less depreciation, less depreciation, depreciation at the rate 10% per annum. Depreciation at the rate 10% per annum for 2019. Over here it would be 2775. Over here it would be 1950. Let us show the calculation. 27750 multiplied by 10% for the whole year. So 12 by 12. And over here 19,500 into 10% into 12 by 12. 1950. And over here for 6 months, we need to do the calculation. 7, 8, 9, 10, 11, 12. These many months. So for 6 months, 10,000 multiplied by 10% multiplied by 6 by 12. This is 500. This is 500. Let us do the totals of depreciation. 2775 plus 1950 plus 500. 5225. 5225. Understood? Let us continue. Let us continue. Write written down value. Write written down value. WDV. 27750 minus 2775 equals 24975. Over here it is 17550 and here it is 9500, as you can see it very easily. Sale proceeds, machine sold, machine sold. Out of 30,000 of machine, only one third, that is 10,000 of machine is sold. 10,000 out of 30,000, that is one third. That is one third. So the written down value is 24,975. We need to do one third. So 1 by 3 multiplied by 24,975 equals, do it on your calculators. 1 by 3 multiplied by 24,975, 8325. 8325. 8325. Written down value. Written down value. 16650. 16650 less depreciation. Less depreciation at the rate 10%. At the rate 10%. 1665. Over here It is 17,550 multiplied by 10%. 17,550 multiplied by 10%, 1755. And over here 9,500 multiplied by 10%, so it is 950. The total depreciation is 4370. If you do the totals, the depreciation is 4370. I believe you understood. Now we can make machinery account. Now we can draw machinery account. Machinery account. Now we can draw machinery account. Date, particulars, amount. Date, particulars, and amount. Debit, credit, date, particulars, amount, date, particulars, amount, date, particulars, amount, date, particulars, amount. 1st of April 2018 to bank account, machinery purchased 20,000 plus 10,000, which is 30,000. 30,000. 1st of October 2018, one more machinery is purchased for 20,000. Totals is 50,000. Totals is 50,000. On the last day, 31st December 2018, by depreciation, by depreciation, by depreciation, 5225, no, 2750, 2750 for 2018, 2750. 50,000 minus 2750 by balance carried down. By balance carried down 47,250. 47,250 by balance carried down 47,250. Let us stretch these lines. First January 2019. 1st January 2019, to balance brought down 47250. 47250. A new machinery is purchased on 1st July 2019 to bank account. The new machinery 10,000. 10,000. So this total would be 57,250. 57,250. 57,250. 31st 12 2019 by depreciation, by depreciation, 5225. 5225, 31st December 2019, by balance brought down, by balance carried down, the closing balance 57,250 minus 5225 minus 5225, 52025, 52025, 52025, 52025. 1st of January 2020, two balance brought down, two balance brought down, 5225, 52025. 1st of January 2020, 1st of January 2020, the machinery became obsolete and sold for 10,000. The machinery became obsolete and sold for 10,000. So bank, by bank account, machinery sold. Machinery sold. One third of the machinery sold for 3,000. We had incurred loss. So by profit and loss account, what is the loss amount? What is the loss amount? So machinery is sold for 8,325. We sold this machinery for 3,000. So the loss is 5,325. We sold this machinery for 3,000. So 8,325 minus 3,000 is 5,325. 5,325. The value of the machinery is 8,325, but it is actually sold for 3,000. So 5,325. Depreciation, depreciation 4730. For 2020 it is 4730, 4370, 4370. Let us do the totals now. 52025, 52025 minus 3,000 minus 5,325 minus 4,370, 39,330, 39,330 by balance carried down, 39,330 by balance carried down. By balance carried down 39,330. Let us continue. Write one more illustration. Write in illustration. The machinery the machinery account the machinery account of a factory the machinery account of a factory showed a balance showed a balance the machinery account of a factory showed a balance of rupee 1,90,000 of rupee 1,90,000 on 1st of January 2020. Its accounts were made its accounts were made its accounts were made up on 31st December. Its accounts were made up on 31st December each year 31st December each year, and depreciation and depreciation is written off, and depreciation is written off at 10% per annum. Depreciation is written off at 10% per annum under the under the under the diminishing balance method. On 1st June 2020, new machinery new machinery acquired at new machinery acquired at a cost of rupee 28,000, and and installation charges incurred incurred in in erecting the machine works erecting the machine works out of rupee 892 on the same date 892 on the same date 892 on the same date on 1st June 2020 on 1st June 2020 a machine a machine which had cost a machine which had cost rupee 6,000 a machine which had cost rupee 6,000 on 1st January 2015 was sold was sold for rupee 750 was sold for rupee 750. Another machine which had cost another machine which had cost another machine which had cost rupee 600 which had cost rupee 600 on 1st of January 2016 was was scrapped on the same date scrapped on the same date and and it realized it realized nothing and it realized nothing. Write up write up plant and machinery account. Write up plant and machinery account allowing the same allowing the same write up plant and machinery account allowing the same rate of depreciation same rate of depreciation as in the past as in the past calculating as in the past calculating depreciation as in the past calculating depreciation to the nearest multiple to the nearest multiple of a rupee to the nearest multiple of a rupee. Kindly refer the question once more. The machinery account of a factory showed a balance of rupee 1,90,000 on 1st of January 2020. Its account were made upon 31st December each year, and depreciation is write off at 10% per annum under the diminishing balance method. On 1st June 2020, new machinery acquired at a cost of rupee 28,000 and installation charges incurred in erecting the machine works out of rupee 892. On the same date, on 1/6/2020, a machine which had cost 6,000 on 1st January 2015 was sold for rupee 750. Another machine which had cost rupees 600 on 1st of January 2016 was scrapped on the same date and realized nothing. Write up plant and machinery account and allowing the same rate of depreciation as in the past, calculating depreciation to the nearest multiple of rupee. I believe you understood the question. Let us try to solve it. Solution. Solution. Working note number one. Working note. Working note 1. Computation of WDV written down value computation of written down value on the date of sale and scrap on the date of sale and scrap. Machine purchased on 1st of January 2015 and 1st of January 2016. 1st of January 2015 and 1st of January 2016. Cost is 6,000. Cost is 6,000. On 1/1/2015 sold for 750. So cost is 6,000 less depreciation less depreciation at the rate 10% per annum for 2015. It is 600. So 6,000 minus 600 is 5,400. 5,400 written down value on WDV on 31st December 2015. 31st December 2015 less depreciation at the rate 10% for 2016. 10% which is 540. 10% which is 540 10% which is 540. This would be 4860 WDV. WDV on 31st December 2016, 4860, less depreciation, less depreciation at the rate 10% for 2017, 486, 486, 4860 minus 486, 4374, 4374, 4374. This is WDV on 31st December 2017. WDV on 31st December 2017. Less depreciation, less depreciation at the rate 10% for 2018, 437.4. So 437. Keeping it 437. 4374 minus 437 is 3937. WDV on 31st December 2018. 3937, less less depreciation at the rate 10% for 2019, 393.7. So 394 WDV on 31st December 2019. WDV on 31st December 2019. 3937 minus 394, 3543. 3543. Less depreciation at the rate 10% from January to May. That is 5 months. That is 5 months. So this would be 148. 148. 3543 minus 148, 3395. WDV on 1/6 2020, 3395. WDV on 1/6 2020, 3395. Another machine was also scrapped. Another machine which had cost rupees 600 on 1st January 2016, scrapped on the same date. 1st January 2016, over here this machinery is scrapped. So 10%, which is 60, 600 minus 60 equals 540. minus 54, 540 minus 54, 486, 486 minus 48.6, which is 49, minus 49, 437 minus 44, minus 44 is 393, 393, and for the 5 months we have to calculate at the rate of 10%. 5 months we need to calculate at the rate of 10%. So this is 16. This is 16. This is 16. 393 minus 16. 377. 393 minus 16 is 377. 393 minus 16 is 377. So this was the computation of WDV on the date of sale and scrap. So there were two machinery purchased. First on 1st January 2015 and second was 1st of January 2016. I believe you understood this. I believe you understood till here. Let us continue. Let us continue. Working note number 2. Working note number 2. Depreciation. Depreciation for the year 2020. Depreciation for the year 2020. Depreciation for the year 2020. Particulars amount. Particulars amount. Balance of machinery. Balance of machinery as on 1st of January 2020, which is given in the question, first line, 1,90,000. Balance of machinery which is given in the question, that is 1,90,000 less written down value WDV of machinery sold and scrapped. So there are two written down values, 3395 and 393. There are two written down values, 3543 and 393. 3543 plus 393. The total is 3936. The total is 3936. 1,90,000 less WDV of the machinery 186,064. 186,064. Written down value of other machineries on 1st of January 2020. On 1st of January 2020, depreciation at the rate 10% on rupee 186,064 for 12 months So over here for 12 months we need to calculate 186,064 multiplied by 10% into 12 by 12. This comes to 18606. This comes to 18606. Depreciation. Depreciation at the rate 10%. At the rate 10% on rupee 28892 for 7 months. For 7 months. So 28892 multiplied by 10% into 7 by 12. This comes to this comes to 1685 1685 1685. So both the depreciation 18606 and 1685 is 20291 20291 20291. Total depreciation for 2020. This is total depreciation. Total depreciation for the year 2020. 20291. 20291. Let us continue. Let us continue. Let us make plant and machinery account now. The final answer, plant and machinery account. Plant and machinery account. Plant and machinery account. Plant and machinery account. Date, particulars, amount. Date, particulars, amount. Debit, credit. On 1st of January 2020, on 1st of January 2020, to balance brought down of machinery, to balance brought down 1,90,000. 1,90,000. On 1/6/2020, new machinery is purchased. On 1st June 2020, new machinery is purchased for 28,000 and erection charges 892 is included. That leads to 28892. That leads to 28892. On 1st of June 2020, the machine is sold for 750. By bank, by bank machinery sold 750. By bank machinery sold 750. On 1st of June 2020, we need to charge depreciation on machinery sold. Depreciation, we have calculated the depreciation in working note number 1. We have used it for 5 months and the depreciation amount is 148. We have used it for 5 months and the depreciation amount is 148. See over here, used it for 5 months and the depreciation amount is 148. On the same lines, We have used another machine for 5 months and the depreciation is 16. The depreciation is 16. Loss on sale of machinery 1/6/2020 by profit and loss account by profit and loss account loss on sale. The book value was 3395 and sold it for 750. So the loss incurred is 2645. The loss incurred is 2645. On 1/6/2020 by P&L account, loss on scrap, loss on scrap. Another machinery, the amount is 377. 377. 377. We need to charge depreciation also. So 31st December 2020 by depreciation. The depreciation was 16 as we have seen in working note number 1. The depreciation is 16 as we have seen in working note number 1. 31st December 2020 by depreciation. Working note number 2. Working note number 2 for 2020, the depreciation is 20291. The depreciation for the year 2020 is 20291. 20291. The depreciation is 20291. Let us do the totals now. Let us do the totals now. 1,90,000 plus 28,892, 28,892. Do it on your calculators. 218,892. It is 218,892. Deduct all the amounts, that is 750 minus 148 minus 2645 minus 377 minus 16 minus 20291. If we deduct all the amounts, we'll get 194665. 194665 by balance carried down. By balance carried down 194665. By balance carried down 194665. I believe you must have understood till here. Let's see what we have done in this illustration. What we have done is this illustration. First, we have done a computation of WDV on the date of sale and scrap. This was working note number 1. So there were two machinery. One was purchased on 1st of January 2015 and another was purchased on 1st of January 2016. We have calculated the WDV on 1st of June 2020. Then we have calculated the depreciation for the year 2020. So the total depreciation was 20,291 and at last we made plant and machinery account. At last we made plant and machinery account. On the debit side we have recorded two balance brought down, that is the opening balance, that is 1,90,000. A new machinery is purchased for 28,000 and erection charges of 892 incurred, that leads to 28,892. Then we have sold a machine for 750. The depreciation was 148 and the loss on sale was 2645. We have transferred the loss to profit and loss account. Then we have charged for another machine the depreciation, that was 16. Loss on scrap. So WDV was 677. So loss on scrap is 6377. Then we have charged the depreciation for the year 2020, that is 20291. And at last we have calculated by balance carried down the closing balance of plant and machinery, and that was 194,665. 194,665. I believe you must have understood till here. I believe you must have understood till here. Fine. So we are stopping here. We are stopping here. We'll continue from here in the next class now. We'll continue from here in the next class now. So today we have learned the computation of written down value of an asset sold and how to depreciate for accounting. Thank you.